When people compare the investment styles of famous billionaires, they often look for a ranking, a winner, or a single best approach to copy. This instinct misses the most important truth. Billionaires did not become successful by discovering one superior strategy, but by finding a strategy that aligned deeply with their temperament, their understanding of risk, and their relationship with time. The differences between their styles are not contradictions. They are expressions of different answers to the same question: how do you behave intelligently under uncertainty for decades without self-destruction? Warren Buffett represents the archetype of long-term value and quality investing. His style is built on patience, simplicity, and an almost obsessive focus on downside protection. Buffett looks for businesses with durable competitive advantages, strong cash flows, and management he trusts. He is willing to hold these businesses for decades, allowing compounding to work quietly. What defines his style is not valuation formulas, but temperament. Buffett's greatest edge is his ability to do nothing, while others panic or chase trends. His strategy works because it minimizes behavioral error and maximizes time in the market. In contrast, George Soros embodies a macro and reflexive approach. Where Buffett avoids frequent action, Soros embraces it selectively. Soros focuses on large economic imbalances, political constraints, and moments where market perception feeds back into reality itself. His investments are often concentrated, asymmetric, and time-sensitive. Soros is willing to change his mind quickly and cut losses aggressively. His style is less about owning great businesses and more about exploiting moments when being right matters far more than being wrong. The common misconception is that Soros takes more risk. In reality, he manages risk dynamically using flexibility as protection rather than patience. Ray Dalio offers a third very different model: systematic diversification and balance. Dalio does not rely on single insights or favorite stocks. Instead, he studies economic cycles and builds portfolios designed to perform across different environments: growth, recession, inflation, and deflation. His all-weather philosophy prioritizes resilience over outperformance. Dalio's style reflects a belief that no one can predict the future consistently, so the correct response is to spread risk intelligently. Where Buffett trusts business quality and Soros trusts adaptability, Dalio trusts structure and balance. Mark Cuban represents a more entrepreneurial and opportunistic style. His investing is driven by understanding products, customers, and execution rather than abstract valuation models. Cuban prefers areas where he can understand the business deeply and influence outcomes indirectly through insight and speed. He is skeptical of leverage hype and anything he does not understand personally. Cuban's style reflects a belief in learning faster than others and staying flexible. His investments often resemble calculated bets on execution rather than long-term ownership or macro theory. Cathie Wood through AZR. Invest represents a conviction-driven innovation style. She concentrates capital in disruptive technologies that she believes will reshape industries over long horizons. Her approach rejects traditional diversification in favor of belief in exponential growth. Wood's style depends heavily on narrative long-term vision and tolerance for volatility. It performs best when markets reward growth and liquidity is abundant, and it is most challenged when conditions reverse. Her presence highlights how investment style is inseparable from market environment and investor psychology. Even within these differences, a unifying pattern emerges. None of these billionaires invest randomly. Each has a coherent philosophy that defines what they ignore as much as what they pursue. Buffett ignores short-term noise. Soros ignores static beliefs. Dalio ignores single-point forecasts. Cuban ignores what he cannot understand. Wood ignores traditional valuation anchors. Their success comes not from the absence of risk, but from choosing which risks they are willing to live with repeatedly, because the true differences between these investment styles only become visible when markets turn hostile, when confidence is punished, and when alignment between temperament and strategy is tested under real pressure. Part 2 is not about which style makes the most money in good times, but which styles survive themselves when conditions change, narratives collapse, and patience is strained. This is where investment style stops being theory and becomes character. Warren Buffett's style proves its strength most clearly during market crashes and long periods of pessimism. When prices fall and fear dominates his emphasis on balance sheets, cash flow, and durability becomes an anchor rather than a constraint. Buffett underperforms during speculative booms, but he preserves capital and confidence when excess unwinds. His weakness, if it can be called that, is opportunity cost during fast-moving technological shifts. Yet Buffett accepts this trade-off consciously. His style is designed not to win every era, but to avoid catastrophic eras. For Buffett, missing upside is acceptable. Losing the ability to compound is not. George Soros's style excels during moments of dislocation and regime change. When markets break, currencies realign, or policy errors accumulate. Soros's reflexive framework shines. His flexibility allows him to reverse positions rapidly and reduce exposure without ego. However, this style demands constant vigilance and emotional resilience. It is mentally expensive. Without discipline, it can degrade into overtrading or narrative chasing. Soros succeeded because he combined aggression with humility. Without that balance, his style becomes unstable, which is why so few can replicate it sustainably. Ray Dalio's diversified systems-driven approach demonstrates its value over full economic cycles rather than single market phases. His portfolios rarely dominate headlines, but they tend to endure. Dalio sacrifices peak performance for consistency across environments. This style works best for those who prioritize capital preservation, scalability, and institutional responsibility. Its weakness is psychological rather than financial. Investors often abandon diversified strategies during strong bull markets because they feel slow and unsatisfying. Dalio's approach demands trust in process over excitement, a requirement that many find harder than it appears. Mark Cuban's entrepreneurial style adapts well to environments where innovation execution and customer behavior matter more than macro precision. His skepticism toward leverage and hype protects him during bubbles, while his curiosity allows him to engage with emerging industries early. Cuban's weakness lies in scalability. His approach relies heavily on personal judgment and hands-on understanding, making it difficult to systematize at massive scale. It works best when capital can move opportunistically rather than institutionally. Cathie Wood's conviction-driven style highlights the most extreme contrast. During periods of abundant liquidity and optimism, her concentrated bets can outperform dramatically. When conditions reverse, volatility becomes brutal. Her approach exposes the tension between belief and adaptability. Without structural risk, control's conviction can drift into rigidity. Wood's experience demonstrates that innovation investing requires not just vision, but mechanisms to survive long periods of disbelief. Her style is not flawed by design, but it is unforgiving to those whose time horizon, capital structure, or emotional tolerance does not truly match it. Across all these styles, a powerful conclusion emerges. No style is universally superior. Each carries strengths that shine in certain environments and weaknesses that are exposed in others. What separates billionaires from imitators is not style selection, but self-knowledge. They choose approaches that match their psychological makeup and then build guardrails around their weaknesses. Another critical insight is that billionaires rarely switch styles dramatically. They refine rather than reinvent. When alignment weakens, they adjust position size, exposure, or pace rather than abandoning their core philosophy. This continuity preserves learning and avoids the destructive reset cycle that afflicts many investors who chase performance from style to style. Ultimately, the comparison of investment styles teaches a deeper lesson than allocation or technique. It teaches that markets reward coherence. When strategy, temperament, time horizon, and risk tolerance align, decision-making becomes sustainable. When they do not, even brilliant ideas collapse under emotional strain. And so the real takeaway from comparing famous billionaires is not to ask, which style should I copy, but which style could I live with through boredom, drawdowns, criticism, and missed opportunities? That question matters more than performance charts, because the greatest enemy in investing is not the market, but the moment when you abandon a good strategy because it no longer fits who you are under pressure. In the end, billionaire investors are not united by a single method. They are united by discipline to remain themselves in environments designed to make people panic, conform, or overreach. Their styles differ, but their survival logic is the same. And it is this logic, rather than any specific trade or framework, that offers the most durable lesson for anyone seeking not just returns, but longevity in the world of investing.